How much money do you need to qualify to buy a $500,000 home in Canada in 2023? That's a question that a lot of people are asking right now, and for good reason. Now, across the country, the average home price ranges depending where you are, but at this point, most consensus suggests that it's almost $700,000. So today's video, we used $500,000 as the benchmark price for an entry-level property in most major communities across the country. Today, you're going to find out how much income it takes to qualify for a $500,000 mortgage across Canada. So you want to find out how much money you need to make to borrow $500,000 on a mortgage in Canada in 2023. Well, if you haven't done so already, you're going to find out that and a lot more, but you should really take some time to hit that subscribe button and like our YouTube channel. If you're enjoying the content, hit that little bell. It helps us to get the news out to more people. By the way, my name is Alex McFadden. I'm a mortgage broker and wealth expert. I've been licensed in the country since 2011 and I've served over 3,500 families. This is how I know what I know. But let's start talking about actually how we figure out what you qualify for. Now, if we rewind back, we actually have to qualify you if you're looking for a mortgage in Canada using something called a debt to income ratio. Now, debt to income ratios are different in different countries and different locations, and they're somewhat calculated differently depending on how mortgages are calculated in different countries, but we're talking about Canada, so let's focus on where we're at here. Now, the standard benchmark for debt to income ratios across the country is 39% and 44%. But of what? What does that even mean? Well, there's two different ratios. Let's break it down. First and foremost, we have a gross debt service ratio and a total debt service ratio. The gross debt service ratio is the total percentage of your gross income as calculated by your lender that's going towards housing costs. This can include property taxes, strata fees, heat, and the mortgage payment. Don't forget the stress test, we'll touch on that soon. So as you can imagine, 39% of your gross income, well, that could seem like a lot for a lot of folks, but let's go back a quick second and talk about this stress test. Now, all Canadian mortgages, with the exception of private lenders, need to qualify their clients on what is called the stress test. This is essentially where the lender takes the interest rate that's being provided, let's assume 5% today, they qualify your payment on the rate of the 7% interest rate. So essentially, they take a rate at 2% above the rate that you're getting, and they qualify your monthly payment for that amount. So in fact, you're not using 39% of your gross income towards your mortgage financing. It's probably closer to 35 or 34%, but we do have to qualify you based on that stress test to prevent against payment shock when interest rates rise. And the idea here is that, well, the Canadian government got ahead of any potential payment shocks or payment rises and said, well, we're going to protect people from themselves and make sure that they can qualify if rates go up, which they have. Now, let's get back to where we were at. So we talked about gross debt servicing. We didn't talk about total debt servicing. Total debt servicing is when the lender calculates not just the property debt, but they also calculate your debt. This could include credit cards, lines of credit, car loans, student loans, all those loans together, and they must be less than 44% of your income. Now, for today's video, we are focusing mostly on how much income it takes to qualify for $500,000. So we're gonna get right back to it right now. Now, in order to help you qualify and understand how much income it takes, it's important to understand how much you're putting down. And this is because there's different guidelines for a insured mortgage in Canada versus an uninsured or insurable mortgage. That's a whole other can of worms. So let's assume today you're putting down 5% on a property and you want to understand, okay, I need a $500,000 loan. What do I actually need, Alex? Give it to me straight. Well, let's do the calculation right now. So for the sake of conversation, you're putting down less than 20%, 5, 10, 15, doesn't matter. At the end of the day, we're gonna get the mortgage amount to $500,000. With a $500,000 loan, we are factoring in property expenses of $2,500. We're factoring in condo fees, because let's be honest, in most major markets, a $500,000 mortgage, you're likely paying strata fees of a townhouse or a condo. And if you're not, well, you're very lucky. And for today's conversation, we're gonna use a heat calculation of $50. A thing to keep in mind, if you're considering these types of qualifications, is that ultimately these calculations for heat can depend on the type of property that you are purchasing. With all that in mind, we're using an interest rate of 5.59% today, and of course we're amortizing the loan over 25 years. So how much income do you think that you would need to qualify for a $500,000 mortgage? If you guessed $126,751, well, You would have been right. That is how much income that you need, gross income, to qualify for a $500,000 mortgage in Canada. Well, does that mean if you had 5% down, you can qualify for a $530,000 or $525,000 purchase price? No. Unfortunately, it does not, because we have this thing called CMHC Insurance, which is a whole other can of worms, but part of that $500,000 includes a CMHC Insurance, or the insurance in general, because there's 3 insurers in the country, to get to that point. So you're not qualifying or borrowing as much as you'd like to hope. That being said, the average gross income in most major markets is over $60,000 right now. And if you put 2 people together, it's reasonable to suggest they could likely qualify for a $500,000 mortgage today. So let's move on. Let's talk a little bit about that insurance, that CMHC insurance. We're not going to go into detail as we've done this in different videos, but the short and sweet is if you're buying a home in Canada in 2023, you are required to put down at least 5%. If you put 5% down, you have to pay up to 4% of the loan amount in insurance. So if the loan is $500,000, guess what? 4% of that, $20,000, is being paid in insurance, which means your total loan would be $520,000 with 5%, or the minimum down payment under 10%. Once you go through the different tiers, 10% down, the percentage goes down. 15%, the premium actually goes down. And when you get to 20%, you don't actually have to pay for the insurance premium. It is something that's completely separate. Now, there are 3 different insurance agencies in the country. They do have some different programs, but they do have to follow the exact same costs when it comes to your insurance fees. Now let's move forward, because the other question is, well, how much income do I need to qualify for a $500,000 loan if I'm putting down 20% on a property today? So let's start off with the difference. If you're putting down 20% on a property, as we just discussed, you no longer have to pay for that insurance program, at least in most circumstances, aside from some specialized programs. Yay! So you should qualify for way more. Sometimes, but not always. You might be surprised. A lot of this will depend on a few factors, but you do have some things working for you. If you were to do the exact same scenario with 20% down over a 25-year amortization, you wouldn't qualify for as much more as you think, or you wouldn't have that much less income with most standard programs. Well, we're going to tell you how to get around that. So if you're putting more than 20% down, how much income do you actually need to qualify? Well, that's a tough question to answer, because this is where it breaks off into the different lenders, programs, amortization periods, and so much more. For today's conversation, if you're looking to qualify and wonder how much income to do the exact same scenario, well, you need remotely close to the same income, with one exception. When you're putting down 20%, you now have the ability to amortize the loan over 30 years. So if we adjust the amortization over 30 years, you'd think, hey, I'll qualify for a lot more mortgage money. Not necessarily. You still require $125,759 worth of income. Not a big difference. Well, why is that? One of the biggest reasons is because when you go ahead and you do an uninsured mortgage, lenders charge a premium, and even more so when you do a 30-year mortgage versus a 25. There's a lot of reasons behind this, but we'll get into that into other videos. The short version is that you will always pay a slightly higher interest rate when you're putting 20% down, and in particular when you're doing a 30-year amortization. So why bother doing it? Well, there are some other factors that you consider. If you can recall, earlier in the episode, I talked about the debt to income ratios. There are some lenders that have different rules and guidelines around debt to income ratios. In particular, if you put 20% or more down, in many situations, lenders will no longer use 39% for the gross debt servicing. If you're a well-qualified borrower with good assets and good credit, they will do 44% total debt across the board. This means that you no longer require $125,000 of income to qualify, but now you only need $111,000 of income to qualify. Now, it's important to note that this doesn't work with every lender, it doesn't work with every person, and you do need decent credit, and you need to make sure that you have the assets and income to back it up. But I have seen lenders go even beyond the 44% to qualify a well-suited borrower. Now, ultimately, does this mean that you're hooped if you can't afford this amount, or you're hooped if you don't have this amount of income? No, this is just a benchmark. Here's how much you need to qualify today for $500,000. If you don't have this amount of income, of course, consider things like looking at a lower priced property. Try to see if you can get a co-signer. See if there's any way that you can increase your down payment by partnering or getting an early inheritance or a gift. Ultimately, this is what the numbers show today. This could change in the future, but don't forget, as interest rates go back down, you will qualify for more, but home prices will also rise because everyone else qualifies at the exact same time. If you got a lot of value from the video today, hit that subscribe link button. Guys, please, all the buttons, everything. I really appreciate you listening in on today's episode, and I look forward to your comments below.